Hey everyone, I recently came across an article that mentioned SIP flow into Indian mutual fund industry in the month of May 23 stood at 14,749 crore. Just 5 years ago in March 17, this SIP flow was 7,119 crore. So basically, SIP flow in Indian mutual fund has more than doubled in last 5 years. And this SIP is growing every year. What does it signify? It clearly signifies that now Indian investors have understood the importance of investing in Indian economy via mutual funds in a systematic manner. Indian investors now understand that Indian economy has a bright future ahead. Today, there are 6.36 crore SIP accounts in Indian mutual funds. Folks, this is a big structural shift. But there is one more structural shift in Indian equity market. It's the rise of index funds, that is passive mutual funds. I was going through research data from AMFI, which is Association of Mutual Funds of India, and I was totally surprised with the data. As per AMFI, index fund AUM, that is asset under management for FY23, stood at 1.67 lakh crore. Last year in FY22, this AUM was around 68,600 crore. So index fund AUM has grown at 144% in last 1 year. So in this video, we'll try to understand more about why index funds are getting popular in India, and then we'll try to understand how to identify index funds for investment. Alright, let's get started. A few years ago, majority of investors would invest their money in active mutual fund schemes because majority of active mutual funds were able to beat the benchmark and generate that alpha, that is additional return. However, over the last few years, it is getting very difficult for active mutual funds to beat the benchmark, especially in large cap category. In one of the report published last year, 50% of large cap funds failed to beat S&P BSE 100 index in 2021 and 82% failed to beat the benchmark over 5-year period. It basically means that majority of investors that invested in active mutual funds did not generate higher return than benchmark. In fact, many active funds have struggled with poor returns. Now, one of the major culprits for underperformance of active mutual fund is expense ratio. It eats your profit. For instance, if the overall return from a mutual fund in a year is, let's say, 12%, and let's say its expense ratio is 1%, then your final return would be 12 minus 1, that is 11%. While this 1% difference looks negligible, over the long term it makes a huge difference due to compounding. And that's why investors are moving towards index funds, that is passive funds, that have relatively lower expense ratio. Another issue with active mutual fund is that there is no guarantee that a top performing mutual fund in the past would continue to outperform. So what happens is that a lot of investors invest in active mutual fund based on their last 1 to 3 years of return and invest in the mutual fund that generate the highest return. The biggest problem with this approach is that there is no guarantee that the active mutual fund that was among the top performing fund in the past would continue to outperform in the future. So after some time, investors realize that their active mutual fund is not performing well, and then they switch to another active mutual fund. Again, after some time, they face the same problem. So ultimately, majority of investors end up generating lower return than benchmark. Hence, now a lot of investors have realized that it makes sense to directly invest in index funds that replicate the benchmark. Now the biggest question is how to select the index fund that is suitable for you. Let's figure it out. So the first step in selecting the index fund is shortlisting which category you want to invest in, as there are multiple categories of index fund. For instance, you have Sensex based index fund, then you have Nifty 50 based index fund, then Nifty Next 50 based index fund, and so on. Now personally, I like Nifty 50 based index fund. The simple reason is Nifty 50 represent the top 50 companies of India that are leader in their sector and include companies like your Reliance, HDFC Bank, ICICI Bank, Infosys, TCS, HCL, Asian Paint, HUL, Titan, Bajaj Finance, Divis Lab, and so on. They are all leaders in their segment. If Indian economy is to grow, these companies are bound to grow. And that is the reason Nifty 50 based index fund should be a part of your passive mutual fund portfolio. Another interesting aspect of Nifty 50 based index fund is that the allocation of your money would happen based on the weightage of the company in the index as per the free float market cap. For example, if Reliance has 10% weightage in Nifty 50, then out of rupees 100, your 10 rupee would be invested in Reliance, and likewise in the remaining 49 stocks. So fund manager doesn't have to take the decision of what to buy and what to sell. He or she simply needs to replicate the index by buying the stock in same proportion as per the weightage of those stocks in the index. And best part is that these index itself are dynamic in nature. It means that if a particular company is not doing well, that is removed from the index, and a particular company that is doing well from stock ranking from 51 to 100 will be shifted to top 50 category. So index fund managers doesn't have to worry about what to buy and what to sell. He or she just need to replicate the index. Now the question is, which index fund is suitable in Nifty 50 category? So first of all, you need to understand that since all Nifty 50 index funds replicate the Nifty 50 index, there won't be a huge difference in risk versus return. Most of the passive funds replicating the same index would generate returns similar to benchmark. And there are many index funds from various fund houses, so you can select any. However, there are a couple of parameters that can make slight difference in your return and risk. So first is obviously the expense ratio. So an index fund with lower expense ratio would have a higher probability of generating returns similar to benchmark. This expense ratio currently varies in the range of 0.05% to 0.3% among various fund houses in Nifty 50 index fund category. And second parameter is tracking error. So tracking error is basically the difference between the index fund return and the returns of the index that the index fund is replicating. Now think about this. If an index fund is replicating Nifty 50, then ideally index fund return should be exactly same as Nifty 50 return, isn't it? But in reality, there would be some difference in return, and Nifty 50 index fund return would be slightly lower than Nifty 50 return. And this is applicable for all index fund. The key reason for this difference is because of 2-3 factors. So first factor is due to the expense ratio the index fund charges. This reduces the overall return. Hence, lower the expense ratio of the index fund, better it is. And second reason is because mutual funds never invest 100% of their assets. In practice, most mutual funds keep 2 to 5% of investable amount in cash or in instruments with higher liquidity to take care of redemption. Additionally, an index fund may see an inflow of cash due to a sudden increase in investment or payout of dividends by stock in its portfolio. In such cases, the fund manager may take some time to reinvest this money, and this can contribute to an increase in tracking error. For example, when the fund manager replicates the index, the fund manager also needs to reallocate the fund in case of addition or removal of a stock from the index. So for instance, let's say if Divis Lab enters into Nifty 50 index and Z exit from Nifty 50, the fund manager would need to invest money in Divis Lab and exit from Z. Likewise, the fund manager needs to keep some cash handy in case of redemption from investors. Also, fund managers need to keep investing the money in the same proportion based on the amount received from the investor. Hence, due to all these factors, there is a tracking error and the return from the index funds are slightly lower than the index. So if you want to invest in an index fund, you need to ensure that the index fund has a lower expense ratio and lower tracking error. But like I said before, there won't be a lot of difference in returns from the fund houses replicating the Nifty 50 index fund. So you can choose any of the index fund. Just set up an SIP in Nifty 50 index fund and it will take care of all your long-term financial goals like your retirement planning, children higher education, and so on. Now the catch with Nifty 50 index fund is that it only invests in top 50 companies that are already large caps. What if you want to have exposure in mid cap and small cap companies that can potentially generate high return? That's where you can consider investing in Nifty 500 index fund that include top 500 companies of India across your large cap, mid cap, and small cap. Again, here your money would be invested as per the weightage of stock in the index. Since your top 100 large cap companies have around 75% weightage, so 75% of your money would be invested in those 100 large cap companies, and remaining 25% money is invested across your remaining 400 mid cap and small cap companies. This could provide stability and can potentially generate higher return. Within this category, currently you have only one option of Motilal Oswal Nifty 500 Index Fund. Nifty 500 Index Fund category is not that popular as of today, so Motilal Oswal Nifty 500 Index Fund has an AUM of around 418 crore. But as the awareness about Nifty 500 Index Fund would increase, it would gain momentum. Currently, this fund has an expense ratio of around 0.4%. Another benefit of investing in Nifty 500 index fund is diversification. Nifty 50 top 3 sectors include your financial services with a weightage of 37.7%, followed with IT with 14.1% weightage, and then consumer goods and durable with 12.6% allocation. Whereas Nifty 500 index top 3 sectors include financial services with 31.7% allocation, then consumer goods and durable with 14.6% allocation, and then IT with 11.2% allocation. So both Nifty 50 and Nifty 500 have financial services as top sector, but the weightage of financial sector is lower in Nifty 500. That comparatively reduces the sector concentration risk. By the way, Nifty 50 consists of total of 14 sector out of 21, whereas Nifty 500 covers all 21 sectors. So Nifty 500 is more diversified in terms of both sector and stock weightage. So Motilal Oswal Nifty 500 index fund can be an option in Nifty 500 index fund category. You can explore Motilal Oswal Nifty 500 index fund from the link in the pinned comment. So in this video, we discussed why index funds are getting popular in India and how you can select the index funds for SIP. In this, we discussed two key factors that impact the return from index fund: tracking error and expense ratio. If you have confidence in growth of Indian economy, then index funds can be a good option to invest your money. Just do SIP in index funds and your long-term financial goals will be taken care. Now tell me in the comments, do you have index fund in your portfolio? And if yes, where do you invest your money? And also let me know which topics you want me to cover in the next videos. In case you find this video useful, do share it with your friends. I'll see you in next video. Till then, take care.